Alright, for this video we want to go over a sample Illinois form IL-1040, which is an individual income tax return. So for this example, we're going to have a taxpayer who is a non-resident of Illinois and is filing a non-resident return to report Illinois source income from a rental property. So we've got the full IL-1040 here with all of the schedules, including the NR. And we also have the federal Form 1040 for a taxpayer, which we'll go through as well. And then lastly, we do have one slide here covering some background information on the fact pattern that we're going to be working with, and then some Illinois-specific notes on non-resident filers here. So if we start with the fact pattern, we've got Jacob, taxpayer here. He is a single filing taxpayer and full-time resident of Florida. And he works full-time as a consultant, earning about $120,500 for the 2022 tax year. Now, as far as investment income goes, he's got some regular interest income from a bank account. He's got a brokerage account that paid him some dividend income during the year, capital gains distributions, and he's also invested in some Florida municipal bonds, which paid him interest income of $85 for the year. Now, for the rental property, he purchased a single-family home in Waukegan, Illinois, and rented it out. He paid $225 for the property, and he spent some money upgrading the appliances, $4,000 in total. Now, the property was placed into service and rented out beginning April 1st, 2022. And the new appliances, because they're 5-year property, personal property, they're going to be eligible for that federal bonus depreciation, which is 100% for 2022. So he's going to claim that on his taxes as well. Now, some Illinois tax notes to just cover before we get into the returns. So who needs to file? Generally, if you're a non-resident of Illinois, you're going to have to file if you're going to end up having Illinois source income that creates an Illinois tax liability. So in other words, is your Illinois source income, that base income, going to exceed the amount of your exemption allowance? If that's the case, then you're going to have a positive number there, and then there's going to be some Illinois income tax at 4.95%, right? Now, if you're invested through a pass-through entity like a partnership or S-corp, you might not have to file if the entity withheld the tax on your behalf, right? So you might not have to file them because the taxes were already withheld and paid, but it's still generally recommended to file to report that income and the withholding, and then see, in some cases you might even get a refund, right, depending on what expenses you have. Now, for the personal exemption, so Illinois residents get an exemption allowance for $2,425. That's the rate for the 2022 year. And non-residents can claim the same exemption allowance, but it's reduced, right? So you have to reduce the exemption allowance based on that ratio of your Illinois source income to your total income, and we'll see what that computation looks like later. And then lastly, just to state again, the federal bonus depreciation rules. So Illinois, like a lot of states, does not follow the federal bonus depreciation rules. So the taxpayers, we have to make adjustments, right? We have to add back the bonus depreciation claimed, deduct the amount of depreciation that's allowed for Illinois purposes. And so all of these adjustments are going to be reported on the IL-4562 and the Schedule M. Now, if we jump over to the tax returns, we'll start with the federal Form 1040. So we've got Jacob's federal 1040 here. We can see his wages reported up on line 1, and then we have the investment income reported down here on lines 2 and 3. You can see we've separated the Florida municipal bond interest of $85, so that is not subject to tax at the federal level, but it is often subject to tax at the state level, so we'll see an adjustment there. We have the capital gain distribution amount of $200 on line 7, and then the net rental real estate income is flowing through from line 8. So if we go look at the Schedule E, so Schedule E was completed to report the rental real estate income and expenses. We can see here that the rents are reported on line 3, and all the various expenses that Jacob was able to claim. And then the amount of depreciation claimed for the year, $8,508. If we have a look at the 4562, we can see how that number was calculated. We've got the special depreciation allowance in Part 2, so the bonus depreciation on that $4,000 of appliances, that is being deducted in full for federal income tax purposes. And then we have the straight line depreciation of the house, right, excluding the land allocation. All right. So all in all, the net rental real estate income for the year was $866. So that's reported here on the Schedule E, and it's reported on Schedule 1 on line 5, right? The rental real estate income, $866. And then ultimately, again, that flows up to page 1 of the 1040, and it's included in his adjusted gross income and taxable income. All right, so now let's have a look at the Illinois 1040. So at the top of the page, we've got the taxpayer's Social Security number, their year of birth, and then full name, and then mailing address here in Florida. Filing status for the taxpayer here is single, so same as the federal. And then on line D, we have checked the non-resident box because we are filing it as a non-resident of Illinois. And so we also will be attaching Schedule NR. Now in step 2 for the income, Illinois, like a lot of states, uses your federal AGI as a starting point, and then you make additions and subtractions to arrive at what is the taxable income calculated under local law, right? So Illinois, line 1, our starting point here is federal AGI, so that's the 123,848 is the federal adjusted gross income coming through from line 11, right? So line 11 on our federal return there. So that's the starting point, and then now we start to get into those adjustments. So line 2 is federally tax-exempt interest and dividends from the federal 1040. There's our $85 amount. So Illinois will tax basically all out-of-state types of municipal bonds, and most Illinois, so in-state municipal bond interest is also subject to tax unless it's specifically exempted. And so they have a publication which lists those types of investments that would be exempted, but in this case, none of those apply. So we have to add back the $85 in interest. And then now we start getting into the other additions coming through from Schedule M, which is the bonus depreciation add back. So if we start with the Illinois 4562, this is where we recalculate the amount of depreciation that is permitted. So in Part 2 here, figure the Illinois Special Depreciation Addition. So on line 1, it's asking us enter the total amount claimed as special depreciation allowance on our current federal 4562, and this is lines 14 and 25. So if we go back to the 4562 for the current year, we can see the current special depreciation allowance. So that's the bonus depreciation allowed for federal purposes, which was $4,000. So there's our $4,000 figure. Line 2 doesn't apply. We don't have any employee business expenses. And this is the first year that we're claiming depreciation, not the last year of regular depreciation. And we haven't disposed of the property either, so those line items are blank. Now, we figured the add back. Now we need to figure out, well, what amount would be allowed for Illinois tax purposes, and that's step 3. So step 3, line items 5, 7, and 8 are used if you claimed bonus depreciation at either a 30, 50, or 80% rate. If you claimed 100% bonus depreciation, like we did for this property, we would use line 10. So line 10, it asks us enter the amount of federal depreciation you would have claimed if you elected not to claim the bonus depreciation on your federal return. So remember, in IRS, code section 168K7, that's the bonus depreciation section. So K7 allows us to elect out of federal bonus depreciation. So if you had elected out of federal bonus depreciation, what would be the amount of depreciation that would have been claimed just under the general makers tables? And that would have been $800. So in this case, we're having an add back of $400, and then we're deducting $800 of depreciation that would be allowed for both federal and Illinois state tax purposes. So once those are completed, then we can move on to Schedule M, where we summarize all those additions and subtractions. So in Step 2, line 5, we have the Illinois Special Depreciation Addition from IL-4562. So there's our $4,000 addition. And then now we go on to Step 3 to figure the subtractions. The depreciation adjustment subtraction is listed down here on line 19. So we have the special depreciation subtraction from 4562. So we've got the $800 figure there. And then now those ultimately flow back up to the 1040. So if we look at the 1040 here, we can see other additions from Schedule M, other subtractions from Schedule M, so there's our amount. So our adjusted Illinois base income after making those corrections is going to be $127,133. Now the exemption allowance here for per person is going to be $2,425. Jacob here is unmarried, he has no dependents, so he's not going to add any others. And then now we get down to Step 5, line 11. So this is where we go over to the Schedule NR, figure out the numbers, and then come back to this. So if we look at the Illinois Schedule NR, Step 1, answer these questions, fill in the information as appropriately, right? So question 1, we were not a full year resident of Illinois, so that's a no. Question 2, we weren't a part year resident at all during the year, so none of these are populated. Question 3, if you were a resident of any of the states listed below, if you were in Illinois only to accompany your spouse who is in the military, or if you elected to use your service member spouse's state of residence for tax purposes, check the appropriate box. So none of these apply, certainly, because Jacob is a resident of Florida, for one, and he's unmarried. But these states have reciprocal agreements with Illinois where if you are working in the state, you can be exempted from tax for this purpose because you're basically commuting and living there because you have a spouse that's in the military, right? And so in our case, none of that applies, so we haven't checked any box. Question 4, though, we do fill in that we are a Florida resident for tax purposes in 2022. Even though Florida doesn't impose any individual income tax, we still are a resident there for the full year. Now, Step 2, it asks us, complete lines 1 through 10 of the 1040 as if we are a full year Illinois resident. Now, why are they doing that? Well, they want us to figure out what would our income be if we were a full year resident, and then figure out what is our income that's attributed just to Illinois, and it's that ratio that we use to calculate that reduced exemption allowance. So in the federal column here, we've got the wages, the interest, the dividend income, capital gain distributions, and that net amount of rental real estate income. The Illinois portion here is just the rental real estate income, right? So we've got the $866 there. None of these other income items are attributed to Illinois. Step 3, in page 2 of the Schedule NR. On the federal column here, nothing left to report, right? None of these apply. We carry over the Illinois portion of federal income from page 1 there, so $866. So when we get down to the totals here, we've got the AGI as reported on IL-1040 line 1 of $123,848, and then the Illinois portion is $866. Now we get into the adjustments, and as they're a portion for 1040 versus the Illinois 1040 portions, right? So we've got our federally tax-exempt interest here, $85. We've got the addition, $4,000, which applies to Illinois. And then we've got the subtraction down here, $800. And then the $800 also applies to Illinois. So if we think about this kind of conceptually here, Illinois is having us recalculate the Illinois portion of income with those adjustments. So 866 is kind of our starting point, but we can't claim the bonus depreciation, so we're adding that back. But we do get to deduct $800 of just regular kind of maker's depreciation, right? Not the bonus. And so that's left us with $4,066 of net income before the exemption allowance that's attributed to Illinois. All right. Now on line 47, asking us pull the base income from IL-1040 line 9. So if I go back to IL-1040 line 9, we could see our base income amount there, $127,133. All right, so that's that number. Line 48 is asking us to divide 46 by 47, and it gives us 3.2%. So 3.2% of our Illinois base income is effectively Illinois source. And we use that 3.2% times the exemption allowance to compute our reduced exemption allowance here on line 50. So now at the very end of this, we've got the $4,066 of the Illinois source base income minus that reduced exemption allowance gives us Illinois taxable income of $3,988. The $3,988 multiplied by 4.95%, which is the tax rate, gives us $197 of taxes. So once we have lines 51 and 52, we can go back to the 1040, populate lines 11 and 12, so we got our $3,988, our $197 in tax. So that's the amount of tax that we're going to owe, right? We don't have any kind of income taxes paid to other states. We don't have any other kind of credits, right? No use taxes owed, nothing like that. So the net amount of tax that Jacob is going to owe here is $197, all right? Now, obviously, if you made estimated payments during the year, you might get credit for that. But in this case, none of that happened. He didn't pay anything in yet, so he's just going to have to pay Illinois the $197 with the return when he files it. All right, so that covers it for this return. I hope that was helpful. If you have any questions, leave me a comment below. And as always, I look forward to seeing you again on the next video. Thank you.